Thank you, gentlemen, for your time. So for Bayo, let me start with you. Listening to the CBN's the rationale for arriving at this decision, holding rates steady, did roll out a number of them. But for you, what sticks out for you?
I think for the market, I think the result is expected.
Okay.
Interest is already down in the market. The banks are trying to meet the LDR target. So there's a lot that the banks, that's monetary policy-wise, has been done to stimulate activity. And I don't think they want to rock the boat at this point in time. It alludes to what they've said. There's a lot of benefit in holding where we are to see how things go. I think beyond that, a lot of the things that have been mentioned only point to the fact that they also begin to recognize the fact that monetary policy alone is not going to solve the problem. The CBN can only do so much, and they've pushed the banks to do so much using their capacity as a regulator. There's a lot of fiscal support that needs to come in to augment what's going on before we can begin to see this kind of positive numbers that we're looking for.
No, absolutely. Obviously, we've always known that, and the CBN has always said that, obviously there needs to be that synergy and cohesion between the monetary and fiscal authorities, although the lines at this point seem to be a little bit blurred. But the CBN was the governor did speak very, it was quite concise on the initiatives of the central bank. They talked about the capital adequacy ratio, the NDR, and of course, increase in credit to the private sector, all the initiatives that were taken by the bank to boost, especially credit to the sector. And he seemed to feel a sense of pride on his part that these initiatives are actually working. And of course, like Bayo said, let's not rock the boat. Let's give the market that chance to experience the benefit, as it were.
Yes, again, directionally, what the governor said was spot on. However, when you take it in terms of materiality, total credit growth of 1.169 trillion in an economy which is 147 trillion GDP, that's not going to move the needle. It's a move in the right direction, but you need leapfrogs. You need some significant changes, not just in credit, but in investment. Foreign direct investment is 1% of GDP already. That's too low. Total capital formation is 14% of GDP. It's too low. It's not going to go anywhere. And if you're looking for short-term wins, low-hanging fruits, these are good moves. And Bayo said, okay, the monetary policy is not going to do it alone. Monetary policy is not to solve fiscal problems. The fiscal initiatives will be there. The monetary policy is to support fiscal activity. So we shouldn't put it the other way around. The reality is that we need to make some structural changes. We will make those structural changes. There's no question about that, because the population growth, and I alluded to some of those things, but the truth is that this is a prudent, I use the word prudent move for a banking and monetary policy perspective.
Sorry to button you, but would you say that we're already on the path to the structural changes?
No, we are on the path. We are moving directionally in the right direction, but we have not touched the structural. You got to go to the foundation.
Okay.
We are still dealing with tactical issues.
All right, I need to bring Roy in here. Roy, let's hear your perspective, your thoughts on the comments from the CBN, and of course, why reasons given to hold rates at this time.
It's a pity we cut away when we did. I would love to have heard the answer around the currency and the pegged currency at the 360 level. So, we in South Africa, we use the currency as the economic shock absorber. Now, if you've got a pegged currency like that, there's no shock absorber on that side. And, there's a lot of talk about the protection of the borders and the cutting off of the illegal produce coming into the country, and, flooding the market with goods, and all these questions, and the banned imported items and currency for those items and what else. But one of the key drivers here, I think, that is a concern for me is this inflation number. I think that's the big thing that's sticking out there for me, is this inflation number. Now, if we've got banned foods that cannot be imported into the country, but what happens if rice can be produced cheaper overseas and brought into Nigeria than the local production? Understand we need the production, we've got to build jobs, build production and capacity within Nigeria, but food inflation sticks out. Now, if those banned food items can be imported at a cheaper price than inside Nigeria, should that not be a consideration to the food inflation side? How are you going to get inflation lower? You're not going to get inflation lower by reducing competition. They cannot keep stepping forward and saying, well, hang on, it's cheaper overseas, we don't want it in our market, we need to produce locally, so we'll just cut off the competition. I'm not sure that's the answer, and maybe some of the panel in country have an answer, but I don't believe that's the answer to how to get food inflation down. Slightly weaker currency might be an answer. Maybe a Naira at 380 versus 360 or 400. Is that an answer to maybe cushion the demand for imports, make imports more expensive through the currency, but more importantly, promote and grow the ability and the possibility of export from Nigeria? Build up production, build up agricultural production, but make it competitive internationally. And again, let's not speak again about the infrastructure side. I think we've dealt with that enough. But is the currency possibly the answer to leveling out of the inflation concern? I am concerned around inflation in Nigeria, and I think that's going to be the key reason why rates won't come lower, cheaper lending, help growth. I think inflation needs to be a focus point.
Roy, I'm afraid we're going to have to leave it there. Thank you so much for being a part of today's MPC discussion. Well, that's all for today. I'm afraid we're going to have to leave it there, and it's the coverage of today's MPC meeting. A big thank you to my guests, Bismarck Rwani, CEO of Financial Derivatives, Bayo Mogore, Chief Dealer at GT Bank, and from our Johannesburg studio, Roy Daniels, Head of Africa Trading Desk at Rand Merchant Bank.